We need to pick up with where we left off last time. The tax depreciation on personal property for a business. For example, the plant and equipment. Normally a 5-year or 7-year recovery period using the Internal Revenue Code, and it would either be double declining balance or straight line method. We need to assume that the asset was placed in service in the middle of the year, regardless of the purchase date. So we're going to consider it half-year property, HY, and for a calendar year it would be like it was purchased July 1. So you will get 6 months depreciation the first year. Now there is an exception to this. This is the mid-quarter convention, the MQ. So if 40% of this type of property, also known as Section 179 property, is placed in service in the last quarter of the year, the last 3 months, then the depreciation begins in the middle of the quarter it is placed in service. So for the fourth quarter, October, November, December, it would be like November 15th, and you get a month and a half. If it's another quarter during the year, you would still be you would still receive a month and a half plus the remaining quarters. All right, let's look at an example. We have ABC Company. A calendar year company places in service 2 assets during the year. The first was a machine that cost $21,000, placed in service on April 9th of 2009. The second was a machine that cost $15,000, placed in service on October 5th, 2009. The two together total $36,000. The $15,000, when you take and divide it by the total $36,000, will be more than 40%. So because more than 40% of ABC's Section 179 property was placed in service during the fourth quarter, October 5th is the fourth quarter of October, November, December, then ABC will start depreciating the first machine on May 15th of 2009. Because when you look at April, May, June is the second quarter, and you will have to use mid-quarter. Halfway through that second quarter is May 15th. And then they will have to start depreciating the second machine halfway through the fourth quarter, November 15th. And the way this is figured is, again, taking the $15,000 for the machine purchased October 5th, and dividing it by the total of the two, $36,000, and so that's 41.67%. All right, that has triggered the mid-quarter convention, the MQ. Now, if the story was changed to where ABC Company, a calendar year company, places in service 2 assets during the year. The first was a machine that cost $21,000, placed in service on April 9th of 2009. The second was a machine that cost $12,000. Then we're looking at a total of $33,000 when you add them together. And if you take what was purchased on October 5th, placed in service on October 5th, take the $12,000, divide by the $33,000, it's 36.36%. So it's under the 40%, so we're looking at the half-year convention. So in this case, ABC will depreciate both assets as if they were acquired halfway through the year, which would be July 1. They'll get 6 months of depreciation on each of the assets. Now, the examples for the rest of this presentation assume that 40% or less of a company's Section 179 of personal property is placed in service in the fourth quarter, so that we're going to be looking at half-year convention. All right, generally the IRS tables for property other than buildings, for example, plant and equipment, again, you're either using a 5-year or 7-year recovery period as a general rule. We're using double declining balance or straight line method, and we're making the assumption the asset was placed in service in the middle of the year, so halfway through, regardless of the purchase date. For an asset with a 5-year recovery period, the first year depreciation is 1/5 times 200%. so that we're looking at double declining balance because of the 200%, so that 1/5 is 20%, and you double it by taking it times the multiple of 2, or 200%. That's 40%. And then if you go and you take a half a year that first year because of the half year convention, you're back to the 20%. All right, so you have tables. Here they've given you the tables on the screen where you're looking at 5-year property would start with that 20% we were looking at the previous slide. Year 2 would be 32, and so on. If you take and sum from 20% for 5-year property through 5.76, that will add up to 100%. The total amount of the property will be depreciated over, in this case, 6 years, even though it's 5-year property. The reason for that is the first year is half year, so then you still have a half a year left in year 6. 7-year property will extend over 8 years, again for the same reason. The first year you're getting a half a year, 6 months, which is 14.29%, and then you're going into the 8th year at 4.46%. If you sum all of the 7-year property column from 14.29% through 4.46, that is 100% as well. Now, double declining balance is considered an accelerated form of depreciation. They're pointing out to you that in year 1, the percents that are there are less than for year 2. And the reason is because year 1 is only a half year's depreciation. And in years 7 through 8, straight line depreciation would be higher under DDB, the double declining balance. These years simply use up the remaining depreciation. Note, again, as I said before, that in the final year, a half year's depreciation expense is allowed. And there they're pointing out they're summing at the end of the recovery period, the entire cost of the asset has been expensed. So 100%, whether you have to use 5-year property or 7-year property for a recovery period. Here we are on May 22nd of 2001. DICO, a calendar year firm, acquired an asset costing $10,000. The asset has a 5-year recovery period. Using the IRS table, tax depreciation is as follows. So we would be using, this is a 5-year recovery period. You would be using from the previous slide those 6 years, starting with 20, 32, 19.2, winding up with 5.76. Simply multiplying it times the cost of the asset. Remember, we're ignoring any residual value for tax purposes. And therefore, when multiplied, you have that first year 2,000, second year 3,200, and so on through 576 for the 6th year, or 2006. If you sum all 6 years, it will sum to be $10,000. On October the 11th, 2001, a calendar year company purchases for $10,000 an asset with a 5-year recovery period, and tax depreciation of the asset is as follows. Year 1 depreciation is the same as it was for the asset purchased on May 22nd. Under makers, depreciation starts in the middle of the year that the property is acquired. So once again, we were assuming that this was just one of several pieces of property, so that this business is still using half year. So here, same results as we had previously. Now, we have something called bonus depreciation. Bonus depreciation applies to new depreciable property other than real property placed in service during 2009 and 2010. It must be taken unless the company files an election not to take it. It is a deduction of 50% of the asset's cost in the first year, with the remainder of the cost depreciated under makers, under the modified accelerated recovery system. So here we have an example. May 22nd, 2009, a calendar year company pays $10,000 for a new, this applies to new assets, with a 5-year recovery period. So the computation is as follows. We take the $10,000. The bonus depreciation is 50%. That's $5,000. That leaves the remaining $5,000 to spread over a 5-year recovery period, which, as you've seen before, is over 6 years. So it's 5,000 times the 20% from that 5-year column that you're still going to get in 2009. So there's an additional 1,000. So a total of 6,000 depreciation in that first year, 2009. Then in 2010, it's the 5,000 times 32%, and so on all the way through that last year, 2014, which is the 6th year, and you're using that 5.76%. When you total all of this, 6,000 in the first year, because it's really accelerated with that bonus, and then you add the rest of them, that still adds up to the total 10,000. You cannot depreciate more than the cost. Now we have on May 22nd, 2009, a calendar year company pays $10,000 for a used asset with a 5-year recovery period. There is no bonus depreciation, so we're just looking for the 5-year recovery period. We're looking at the 6 years beginning with 2009, and we're still using those rates from that 5-year column, the 20%, 32%, and so on, and you're taking 10,000 times these rates. So that first year there's only 2,000 instead of the way we were looking at it before, 6,000 for a new asset with bonus depreciation. Still, all of the depreciation expense totals 10,000. All right, we have Section 179 deduction, and Section 179 is just from the Internal Revenue Code. Section 179 is that portion in the Internal Revenue Code, that place where you can find it. It applies only to depreciable property other than real property. So it is applying to personal property, such things as plant, equipment, vehicles. It can be taken up to $250,000 for new plant and equipment acquired in 2009, but can never reduce the company's income from its trade and business activities below zero. So you're limited by the revenue, what the profit is. You cannot go into a loss situation by costing out more using Section 179. Section 179 deductions are reduced dollar for dollar when the total original cost basis of plant and equipment acquired during the year exceeds $800,000. So during 2009, Duco acquires equipment, 7-year property that costs $350,000. Depreciation for 2009 through 2011 is as follows. All right, they are allowed to have a Section 179 deduction in 2009 of $250,000. So they bought property that cost $350,000. So they've got room. They take the $250,000. That $350,000 less $250,000 leaves $100,000 still to be expensed. The 7-year property, you would have to go back and look at the table on a previous slide and see that that first year for 7-year property is 14.29%. So multiply that times the 100,000. That would give 14,290. So for 2009, your Section 179 plus the 7-year depreciation is 264,290. For years 2 and 3, or 2010 and 2011, you would be pulling the percent of 24.49 and 17.49%, multiplying times the 100,000, and that would yield what you see on the screen: 24,490 for 2010, the second year, and 17,490 for 2011, the third year.